color this is. And they have a bit of a sheen to them, right?
Uh-huh.
And so I seem to wear them on at Friday. If I wear them on Friday, it's like I wear them like 4 Fridays in a row. But I have several of these shirts. But I have other colors. Next week I'll wear a different color. Remember the one that blended into the background?
Yeah, I do remember that one. It was pretty cool, actually. I like that.
Yeah, I need one that blends into the chair, so it looks like I'm just a floating head.
Ooh, now that would be that's a clever thought. I mean, it's I could probably do some things in post production to make it look that way. If
Can
we
you put
wanted to.
like one of those mesh fishnet shirts on me in post production?
I can
That'd be
probably.
great.
There's a lot of different things that I can do in post production. I can.
That would make sure we get no more viewers.
There we go. Yeah, that's kind of what we're going for. The fewer, the better. That
There
way, we're
there
not
would be a lot of
embarrassing
comments
ourselves.
like, just please make him eat salads. Huh.
I had someone was telling me the other day we have a putting green here in my neighborhood, and
Oh, that's
I
cool.
was talking to somebody about that the other day, and they said you need to go out there sometime and how do they say it? You need to go out there shirtless and try to pick up girls. I said, with this body, you're gonna need to pick one or the other. I can't do both. I can either go shirtless or I can try to pick up girls.
Yeah,
But you're gonna have to pick one here.
yeah.
So
I'll just pick up a misdemeanor if I do that.
that's right. Well, so we just keep roaring higher here. I mean, 63.89. I mean, we're getting closer and closer to your year-end target. I mean, we're not there yet, but we're only 8-9% away from your optimistic stretch target, year-end target. I mean, what's going on with this thing? It just keeps going higher and higher. Is the market starting to think that we might get a cut? You think? Could that be part of it, or is it still just Matt that thinks we're getting a cut next week? Is it next week? Yeah, next week.
So I would say the market it's getting into a very, call it a very sanguine place, a very happy place. We're starting to see some of the traders capitulate and really to enter the market. And I have not checked the AAI bull bear. It's been a kind of a busy week, so I've been a little bit away from my data that I normally am. So I apologize to everyone. But what I can tell you is the VIX is now below 15. It's living in a very, very low. We're not seeing a lot of volatility. We're not seeing a lot of people hedge future risk. And this is typically what happens before the market usually corrects for a little bit. So it's seasonality. It's everything's lining up. We normally have about a 2-ish% July. It rolls right through into July, into August, and then sometime in the middle of August, there's a pullback. There's some catalyst that causes pullback. You name it, they're always there. I think in 2023 we had a good August, but most August is usually is the beginning of some sort of a distribution process that lasts about 6 to 8 weeks. So I think there's probably going to be I think we're going to get one of those probably starting second week ish of August. Okay, and I think it will have to do with probably language out of the president in regards to the Federal Reserve and the independence of the Federal Reserve being brought into question again. Tariff deals that I think are priced in that may not come to fruition, or at least won't come to fruition as much as is priced in, right? There could also be some issues in regards to current deals that may not be as strong as we think that they are. And again, there could be an issue with Canada or Mexico or China, fentanyl. There's a lot of sort of headline risk orbiting the market right now, and the market is not really pricing that in. The market's pricing in everything kind of going the right way and getting into the final quarter of the year with good earnings revisions, and people are going to start looking into the end of 2026, into 2027 already. 2025 is over as far as earnings are concerned. As far as we have earnings coming up next week. I get that, but as far as pricing in earnings and the price, that's pretty much over. So, we're seeing 80%
Clarify that you're
of the
not
market.
saying that we still have more earnings that will be reported, but that's already baked into the stock market at this point. That's not affecting it's not affecting day-to-day movements in it. We basically already planned for what our earnings are going to be for 2025. Is that what you're saying?
Correct. I mean, we've got call it 33% of the companies have reported. It's about a third of the S&P has already reported. Okay. And 84% are beating by an average surprise of 6%. I mean, that's solid. It's just solid. On the top line, the median is we're beating estimates by 3%. 80% of those are beating estimates. So we're seeing a lot of beats on both the top line and the earnings side. However, there was a lot of poor guidance given, so these thresholds aren't very high to jump over. So the market's kind of looking through a lot of potential headwinds right now because they're looking into this deregulatory environment. I think a lot of it has to do with the retail side not understanding some of the fundamentals, and they look a lot at the headline risk specifically as it relates to Trump, and they're looking at this deregulated environment as a whole. And I think he's I think, for lack of a better word, not to get political here, but I think Trump is growing his mandate right now because he's kind of doing what he said he was going to do, and there hasn't been inflation. We haven't seen any signs of inflation. We're starting to see big surpluses now come into the Treasury, so that's going to be good for the bond market. The market's also going to start pricing in. I think the retail side is seeing this too. The market's also going to start pricing in a dovish Fed here into the end of this year, into next year, which is going to be another leg on this market. Okay, then I think that's what's going to take it to that 6,900 in a year, and that's what's also going to bring that 10-year back down to 375. Again, I don't think we can get to a 6,900 S&P with a 4+ percent 10-year Treasury note. Those things kind of work in concert with each other. So there's a lot of giddiness in the market, and we just seen the return of meme trades this week again with Kohl's and everything like that. So we're starting to see these animal spirits really come back into the market. And when you're sitting at a VIX of 15, you're sitting at a multiple of 22.5, 23 times right now. Again, we talked about this last week. Although it's expensive, it's not expensive because there's a lot of growth happening. The economy really is firing well. Okay, we're starting to see some issues here. Again, we saw initial claims this week at 217,000 on 227,000 consensus. So although it beat consensus estimates, it's still too high. So a little bit too high. I like that below about 190,000, but it's not bad. Okay, so I do think you fix the roof when the sun is shining. You don't step on the brakes after you've already hit the wall. Okay, you start easing into it. So it's time for the Fed to cut, and I think Trump visiting the Fed this week, was it a mistake? Was it not a mistake? It's that's a matter of opinion. I understand why he did it, but I think that's going to increase the resolve of the Federal Reserve to not cut rates, for nothing else but to show their independence, right?
Yeah.
I believe that's the 5th time in history that a president visited the Federal Reserve. That was it, the 5th time. The time before that was George W. Bush, 20-ish plus years ago. So it's very few, and it's very far between because of the not the perceived but the true independence of the Federal Reserve, right? We have to have fiscal policy and monetary policy look across the river from each other and not engage each other. Okay, that's how the whole thing works. But he did put a little bit of pressure on Powell yesterday in regards to I know he'll do the right thing. He knows he has to cut rates. I know he'll do the right thing. Obviously, putting Jay Powell in a very difficult spot. Jay Powell, I think, is an incredibly good communicator and a very smart guy. I do think he's wrong. I do think he's late. I do think he needs to cut rates, but I don't think he's going to. And if there was a chance he was going to cut rates, I think that just flew out the door yesterday because of him going there. So it was funny. I went to the CME Fed Watch last night after everything came out. I think we were running at about a 4 to 5% chance of a cut on the 30th. It dropped down to 2 after Trump's meeting. So, and this is one of those times where it's two-sided. He should cut, but because Trump went there and put pressure on him to cut, now he shouldn't cut because we have to have an independent Fed. And if it even looks like the Fed's not independent, if it looks like the president can walk over there, drive down the street, put pressure on the chairman of the Federal Reserve and get him to cut rates, I would expect you would see the longer end of the curve, your 20s and 30s, just go through the roof. Okay, that would really put that sort of sovereign risk and raise it to another level, and you would see the longer end of the curve just absolutely go bonkers, and you'd probably see the 30 get to 5.5%, 6%.
So it's interesting what you just said there about he should cut, but now he shouldn't because of.
Yeah.
I mean,
Mathematically he should, but yes, mathematically he should now, but because of the pressure that was put on him, no, he shouldn't. That's kind of weird.
Yeah, and it's So at this point, I mean, you're not saying that you're not predicting that it's going to happen next week. It should happen, but you don't think it's going to.
No, it's not.
And do you still think 2 to 3 rate cuts this year?
I do.
Or does that? Okay. So you
I
think
think,
he's going to?
I think we're going to get 3. I think we're probably going to get a double. So, again,
and when would those?
I mean, we've been saying 2 to 4 rate cuts. We've been saying 3 rate cuts plus or minus 1, so 2 to 4.
Mm-hmm.
We've been saying that since January, right? And we're sticking with it.
Okay. So when would because I believe when we talked about it before, you said probably 1 in July, 1 in like October, 1 in November or September and November. When would that? Because now we're running out of opportunities, I guess, for that. So what's your schedule of when you?
The September cut, a November cut, and a December cut.
Okay.
2020, 25, 25, and 25. Unless something drastically changes with the data, all of a sudden inflation comes out of nowhere. But again, we didn't see any inflation whatsoever manifest itself in PPI. We haven't seen it. Okay, we're not seeing an extreme cooling off in economics. We've had great retail sales, so there is a case to be made to hold, right? But the case to cut is cut a little to remove a little bit of restrictions so we don't cause an uncontrollable dumpster fire here. Not because the economy's slowing down. It's, again, you fix the roof when the sun is shining. What we want is an economy that can grow at 2.5 to 3.5% every year for the next, in perpetuity. That's what we're trying to do. So if you're constantly on and off the gas, it's really hard to find the middle ground. It's funny. So this week I've been teaching my son, who's 8, how to drive the golf cart. So we live in a nice community, a little gated community, and you can drive around. So we have a golf cart and that pulls the race cars around. So he's 8 years old and he can reach pedals and he's driving around and he's like, and you're like, huh, you're back and forth. You're like, oh my gosh. And I was like, that's the Federal Reserve right now. That's the Federal Reserve right now. Like, like, no, just find a nice cruise speed, let it rock, let it roll, let the economy grow, make sure there's enough, make sure the cost of capital isn't so prohibitive that there can be good innovation, especially in the AI space, especially in the tech space, in healthcare and all those other places. And let the United States really cement itself as the core of innovation and economic growth in the world. Not this fits and starts. I think if you look at the bond market this year, it's been all over the place. I remember you're getting the 10-year Treasury note has the beta now almost of the S&P 500, but no return. I mean, it shouldn't be this way. It should not be this way.
Yeah. You brought up the VIX, and while we're kind of unprepared and shooting from the hip, we'll talk about the VIX a little bit because that was something that when I was managing money, I was fascinated by the VIX. I looked at it a lot. It was a bigger part of my investment process than it might be for some advisors. And there was the reason for that. And we may have talked about this a long time ago, but if we know that earnings are going to go into evaluation for a company, we know that the balance sheet and all the data behind valuing companies are we know the process that goes into that. We know that higher interest rates increases the risk premium, which in theory makes stock prices go down and vice versa, except sometimes when it doesn't. But one thing that I never really hear talked about a whole lot is the volatility premium or volatility adjustment for if you give me 2 stocks that are 100% identical on a PE ratio, a PEG ratio, the growth metrics, everything are the same, but one has a beta of 2 and the other has a beta of 1. To me, the higher volatility stock should be worth less because I'm taking more risk to own that stock. Do you ever subscribe to that type of a theory? I mean, if you have a choice of 2 different stocks, do you tend to go with the one that's going to be a little bit more consistent and a little bit more steady? And really the point to that question is to get to, okay, we know that the market volatility goes up usually when the market goes down and vice versa, but it's almost a chicken or the egg question. Does the market go up because volatility is low, or does volatility go down because you're willing to take a little bit less return in calmer times, and that causes the market to go up. Does this? I know I'm just kind of making like a circular argument almost, but do you think does a low VIX give us more justification to be at 24 times earnings?
So, in my estimation, no. Okay.
Okay.
So what the VIX is, the price of the VIX is the price of the futures contracts of the S&P 500 30 days out. Okay. And how much does it cost to buy puts or calls on to buy those contracts? Okay. How much does it cost to hedge your risk? Okay.
Yeah.
30 days out. And when the VIX is very, very high, it costs a lot of money to hedge the market 30 days out. Okay. When the VIX is very, very low, it's very, very cheap to do it. So right now it's very, very cheap to hedge risk 30 days out. Okay. And that means what that tells you is there's not a lot of perceived risk in the market. There's not a lot of people hedging their risk right now. Okay. And that's when I start to go, well, that means everyone's buying and they're not seeing any risk coming down the road. Okay. And that's when risk shows up. Okay. So, it's something, there always has to be a catalyst that moves the market right down. So, and it's that catalyst that causes the market to move. The chicken or the egg question. It's funny. I don't know. That's a really great question, because if the market,
it's almost a philosophical question.
It is like
an investment, but
if the market overreacts, which it always does, okay, and that causes the VIX to go up tremendous, much, much higher than it should, which can then sometimes obviously cause the market to go down further than it should. So it kind of starts to feed on itself, which is exactly what we saw in April. We saw, VIX at 60. Okay. Yeah. I mean, I don't know about you, but I'm looking at an incredibly strong market, an incredibly good earnings platform, an incredibly good economy. Well, not a good economy. Why would I want to spend that much money to hedge risk at 4,800 on the S&P?
Yeah,
right. That's the at 4,800. You're buying this thing at 18 times earnings when it's growing by 15% or 14%. Not a lot of risk there. So it goes to show you that it's the emotional side of the market, and that's why the VIX is called the fear gauge. Fear is an emotion. Okay. Yeah. So the VIX really is. I mean, I guess as we're talking about this out loud, maybe it's kind of clearing this up for me a little bit. The VIX is the fear gauge. The VIX is the emotion of the market. It is the emotional metric of the market. It's okay. We know, is the market emotional right now? No, right now it's out by the pool. It's sipping on its martini. It's listening to Christopher Cross, maybe a little bit of Michael McDonald, right? And it's day drinking. Yeah. Okay. It's the right time of year for it. Okay. But something will happen, one of the kids will come home from being out with their friends and crash through the garage, and then, his martini glass goes flying, have to go chase him. And that's going to happen. So, but that's typically what we get this time of year.
That was a beautiful story. I mean, the way you brought the market to life, that was just a beautiful. I love the way you did that. I think back to like 2017 was absolutely my favorite year to ever be a financial advisor. It was the way I managed money was I would usually buy out of the money put options to hedge equity risk, and that actually allowed me to take more risk or put more equities in the portfolio than I would otherwise. And 2017 was great because I was buying put options for it was costing me something like 2% per year annualized to hedge any drop more than 10% or so in the market. So it was super cheap. And I mean, we made like 18 or 28, 30% that year. And it was just calm as it can be. If the market, but the VIX was at like 10 at that time.
Yeah, actually fell to 9.
Yeah, it got to single digits at one point. And that's very abnormal. 15 is right at the historical long-term average. 20 is getting high. But when we talked about on the last show that, for this market to be at 6,900, it needs a 3.5% 10-year treasury. Right. But I'll just kind of philosophically, I guess, wonder sometimes if the VIX stays at 10 or 12 for a very, very long period of time, do people get to a point where they kind of forget that stocks have risk and therefore start paying more and more for it? And then really, that's exactly what happened in the tech bubble. People forgot that you could lose money in the stock market, and they just started paying 17,000 times revenue to buy into an IPO. And what happens eventually? Bubble pops, and there you go. But anyway, interesting philosophical question.
It is, and that's where the fundamental work is so important, right? Is you have to know, like, well, all right. I mean, yeah, we have a good market, we have a good economy. There's, maybe these trade deals get worked out, some of them won't. Um, but when the market gets this relaxed, this quiet, this sanguine, that's when at this multiple, by the way, at 23 times earnings, by the way, okay,
Yeah.
that's when you're walking down the street with your girlfriend and somebody clocks you in the side of the face and knocks you out because you're not expecting it. Everything is going so well, okay.
Yeah.
And but here's the thing: is I'm not one of those people who's always waiting for another shoe to drop and bearish all the time. Nothing like that. This is a good market. And this is a good economy. I'm not.
Objectively
deploying.
optimistic.
Exactly. I'm not deploying new capital right here, right now. Again, we're not timing the market. We're pricing the market. And seasonality is not in our favor right now, and it's highly likely there's going to be a much better opportunity at a little bit lower level to kind of deploy some of this new capital. But it's certainly not something you would want to sell. You certainly would not want to sell this market. It's just something you might want to wait till a little bit better opportunity to buy. And my guess is I think that the risk right now I think is to the downside. I think we have asymmetric risk. Probably my guess is we'll get another there's probably another % or so left in this market, okay, before any sort of a distribution cycle begins. And I think that distribution cycle will probably live in the 6 to 9% range, okay, somewhere in there, okay. And that's probably all we're going to get, and we'll probably have more clarity into the fall in terms of again, more trade deals. We'll probably have a new Fed chair nominee, and we'll probably start to get serious traction with dovish language out of the Federal Reserve. Okay. And I think it's going to be that's going to take the market to that 6,900 level. And it's going to be the bond market. It's going to be the bond market that takes the equity market there because of what the perceived interest rate regime is going to look like over the next 3 years.
So might be putting you on the spot just a little bit here, I guess, but 6,900 is your in target. You said that you're not really putting money to work right now. If I recall correct, and I might not be, but the last time we were around this similar spot, early part of the year, February-ish, you had a price level, I think around maybe 5,500 that you said if we get there, I'm buying it hand over fist. Mm-hmm. Do you have a price level now that you say, okay, no, I'm not really doing it right now, but if we get to this is my go point.
Yeah, like 6,100.
Okay.
Yes,
so it's a little higher now. Your floor would be a little higher now than it was back in January, February.
Yeah, I mean, I fully expect to see a 5 handle again before the end of the year, on the S&P. But I might not. So, but I would say if we get a 60 handle, anything, that's fine. That's good enough, because that'll give me a nice little 5% pullback, which is okay. And so again, we're not timing the market or anything like that. It's just things are a little expensive going into a weak seasonal period. We've got some headline risk coming down the pike right now, and these things, and we have a very, very low VIX, and we're starting to see the bulls win over the bears in the AAII. I think the rally that we had from April 30th or April the 8th up to today absolutely was deserving. People that missed out, I'm sorry, you guys missed out on it.
You should have been watching the Intelligent Investment Show.
You shouldn't have hated it. It was there. It was there for the taking. There's nothing wrong with this market, but the market has run basically 31% since those bottoms. So, that was your easy money. The easy money's over now. So the other side of it is what are we going to call this thing? We call it a distribution cycle. That's exactly what it's going to be. There's going to be a catalyst that starts it, whatever that is, but it's going to be a distribution cycle because a lot of people, they made that 31%. They made a lot of money since that sort of that first, second, third week of April.
Yeah.
And they're going to hold on to it until they see a reason not to.
Yeah.
And that's going to start that distribution cycle, because they're going to distribute the gains from April the 8th to, call it, maybe August 10th. Okay.
Yeah.
And that distribution cycle will probably last 6 to 8 weeks.
Yeah.
So,
well, thank you for your insights. As always, you are right more often than not. So I always enjoy hearing what you got to say. I will read off really quick it's not reading, this is just my normal disclosure. We are here for your entertainment, education, and amusement only. We're not here to give you financial or investment advice. If you want financial or investment advice, call Matt at 702-655-8300. Did I get that right this time? I'm always saying it wrong. Is it 8200 or 8300?
8300. 702-655-8300. I sound like a personal injury attorney.
Yeah, I usually pull up your website, so because I kept butchering it for a while, but I think I have it memorized at this point. I've said it enough times. But anyway, give them a call or go to intelligentinvestment.com. But I got some blowback from the compliance department that apparently I was supposed to play the full disclosures at the end of the show. So I'm going to do that now. Matt, you can stick around and listen to it if you want, or you can not. But I'm just going to hit play on this thing, and you can hear me do my very best radio impersonation of saying a lot of things really, really fast.
Thank God for compliance. They keep us. They keep us in compliance.
Absolutely, they keep us out of trouble, which is we do appreciate. So, Matt, pleasure as always. Are we on next week? Next week is next week the big show, or is that 2 weeks?
Yeah, next week's the big show. I'm not sure if we'll do a button-up version though. I don't know that's important.
We'll talk about it. Yeah. Sounds good. Well, I'm going to play the disclosures and see you next time, and have a great weekend.
You too, my friend.
See you. Bye.
Discussions in the Intelligent Investment Show are for educational purposes only. The information presented should not be considered specific investment advice or a recommendation to take any particular course of action. Always consult with a financial professional regarding your personal situation before making investment or financial decisions. The views and opinions expressed are based on current economic and market conditions and are subject to change. There is no guarantee that any statements of future expectations will come to fruition. All investing involves risk, including the potential for loss of principal. Securities offered through United Planners Financial Services, member FINRA, SIPC. Advisory services offered through American Retirement Planning Group, ARPG, and United Planners are independent companies. Garrett Lill and Wealth Partners are not affiliated with ARPG or United Planners. Any endorsement that I may have given during this recording, it is important to note that I am not a client of ARPG. The views expressed should not be considered representative in any way of my past, present, or future experience with Matt or ARPG. No incentives have been provided to me in connection with any endorsements I may have given on the Intelligent Investment Show. Investing involves risks, and there is no guarantee of any future results, performance, or success.